One of the biggest types of risk that a bondholder is going to pay attention to is default risk. And default risk is the risk that a bond issuer will default, essentially meaning that the borrower fails to make one of the payments that they promised to make. And so the borrower, when they issue a bond, they promise to make periodic payments of interest and also pay off the amount that was borrowed. And if they fail to make any of these payments, they are considered to be in default. And so there are a lot of things that go into default risk on a firm-specific basis. This default risk is influenced by the issuer's financial strength and different terms that can be built into the bond contract. So financial strength is big here because essentially what the issuer does is they promise to make periodic payments. And so in order to actually make those periodic payments on schedule, they must be financially sound. Higher default risk requires bonds to offer higher yields. And so this kind of goes along with one of the primary thoughts in finance is higher risk requires higher return to give investors incentive to buy the bond. And so what this means up front, if a bond is going to offer a higher yield, when the bond is first issued, if an issuer is in better financial shape, they can offer lower coupon rates. So there are various types of bonds and various characteristics of bonds that can be offered. One type of bond is referred to as a mortgage bond, and a mortgage bond is oftentimes referred to as a secured bond. A mortgage bond is a bond that's backed by fixed assets. So essentially, what happens with a secured bond is that there are assets pledged in the circumstance that the issuer can't make their promised payments. The assets can go to the bondholders who are able to sell it to recover their losses from not receiving their promised payments. Another type of bond is a debenture, and a debenture oftentimes is referred to as an unsecured bond, meaning that there are no assets pledged as security for the obligation. And so in the case of default, what that means is the secured bondholders get the secured bondholders have assets pledged that they can sell, but the unsecured bondholders don't have any assets that they can sell that are pledged directly to them in the case of default. So what that means is a debenture bondholder will only get to sell assets to recover their losses after the secured bondholders have been able to sell off assets that are pledged to them. So we're setting up this kind of pecking order where the secured bondholders get paid off first, then the debenture bondholders get paid off to sell assets if the company can't pay off their debts. Next in line is the subordinated debenture bondholders. And so the subordinated debentures only get paid after what's referred to as senior debt has been paid. And essentially what this means is the senior debt is higher up in that payoff pecking order, where the secured bondholders get paid first, then the debenture bondholders, and then the subordinated debenture bondholders. It's basically like a list of who gets paid off in what order. And so these subordinated debentures would be considered riskier than a debenture because the subordinated debentures only get paid after the debenture bondholders get paid. The debentures would be considered riskier than a secured bond because the debenture bondholders only get paid off after the secured bondholders do. So the typical investor doesn't necessarily know how to analyze bond risk. And there are three major ratings agencies that communicate bond ratings to try to let people know how safe or how risky different bonds are. The three major rating agencies are Moody's, Standard and Poor's, and Fitch. And the idea behind a bond rating is that it reflects the probability that a bond will go into default. A better rating means the bondholder can feel safer in that they're expecting to receive their promised payments. So ratings are important to firms and investors. From the firm perspective, a rating is going to influence my cost of debt. If I want to issue new bonds, if my bonds all have high ratings, they're rated really well, I'm not going to have to offer a very high coupon rate. But if my bonds have very poor ratings, I'm going to have to offer a really high coupon rate to get the investors the high yield that they'll demand to take on the risk of my bonds. Also, from the perspective of different financial institutions, like commercial banks, lots of financial institutions are restricted in the bonds that they can hold, meaning that the bonds have to be highly rated. They have to be considered very safe for financial institutions to be able to hold on to these types of securities. And so if bonds are rated highly, that opens up a bigger investor base, including financial institutions who are restricted, certain financial institutions that are restricted from being able to hold on to certain risky debt securities. So how does this rating system work? Moody's and S&P both issue ratings that are meant to reflect the probability that a company will go into default, and the rating systems that each of these companies use are relatively similar. You see, Moody's goes from starts off with a AAA, so does S&P. Moody's goes down to AA, so does S&P. And so especially amongst the A ratings, the two companies are basically the same, just one incorporates some lowercase letters and the other does not. Where they start to differ a little bit is when you get down into the high B ratings categories, where S&P has this triple B rating in their system, and Moody's has a Baa rating in their system, a Baa rating. Those two things basically mean the same thing. And then you move further down the list, where S&P has a double B, whereas Moody's has the Ba rating. And so essentially the rule of thumb that you can follow if you're comparing Moody's and S&P is, first off, you want the more letters that are there, the healthier the firm is. The more letters and the closer to the top of the alphabet, the better. So take the top of the alphabet first for S&P. AAA is best because you're close to the top of the alphabet and you have more letters. As you move from left to right, the bonds are considered to get riskier and riskier. So AAA and AA bonds are considered extremely safe, very, very low probability of default. Historically, that holds very true. These AAA and AA bonds very rarely default. So anything in this category where you see AAA, AA, single A, or triple B, these are all investment grade bonds, considered to be pretty safe to invest in, but there's still sort of this safety order as you go from left to right, where AAA bonds would be considered quite a bit safer than BBB bonds. Once you get below the investment grade bonds, you get into this junk bond territory where there is considered to be a significant probability of default. All investment grade bonds are considered to be relatively safe, but once you get into junk bond territory, things get a little bit more risky. So ratings agencies, to make sure that ratings reflect current probabilities of default, they will review outstanding bonds on a periodic basis. The thing is, the rating is issued and that rating may stand for quite a bit of time. So when you're looking at a bond's rating, it's important to see when that rating was issued and if it's ever been revised. So the ratings agencies are supposed to upgrade and downgrade bond ratings as the issuer's characteristics change. A downgrade would be a worse rating, where the rating gets worse. Where the upgrade is where the rating gets better. So the idea is if the firm gets healthier over time, their ratings should get upgraded to reflect a lower probability of default. Whereas if the firm gets less healthy over time, their ratings should get downgraded to reflect a higher probability of default. So the ratings agencies are supposed to periodically review their ratings, but ratings can be considered stale if there's a considerable lag between a change in credit quality and a change in rating. It is possible that the firm's condition either deteriorates or gets better over time, but it's not reflected in the rating. So that's why it's important to pay attention to when a rating was issued, because you want to know if that rating actually reflects their current condition or if it may be a little old and stale and not necessarily reflect how well the firm is doing currently. So this table shows us a list with bond ratings and the frequency of default. It breaks things into the Moody's and S&P grades, where you have your investment grade bonds here and your high yield bonds. High yield is just another term for junk bonds. And so what this table does in this column is it shows us what percentage of bonds default within 10 years of issue based on the rating that they had at the time of issue. So basically what this table is doing is it's showing us how well are the ratings agencies doing. Because if the ratings agencies are doing a good job, there shouldn't be a high level of default in investment grade bonds, and there should be much higher levels of default in these high yield junk bonds. Also, what we should see as we move from top to bottom on this list is that rates of default should increase, because not only do we want to know that investment grade bonds default rarely relative to the junk bonds, we also want to know that the individual ratings, as you move from AAA to AA and AA to single A, have meaning in terms of separating firms out from their default probabilities. And that's pretty much exactly what we see in this table. Is historically these ratings that firms have been given when they issue bonds seem to be pretty good predictors, pretty highly correlated with the probability of default. AAA bonds very, very rarely default. Only 0.6% of AAA bonds go into default within 10 years of when the bonds are issued. And as you move down the list, AA bonds, still very, very safe. Only 0.8% of those bonds end up going into a default category. And then once you move to single A, 1.9, Then triple B, 5.2. So pretty big jump once you get from single A to triple B, but all of that is considered high yield. Or all of that is not considered high yield. All of that is considered relatively safe debt. It's high yield where you see this really big jump. 16% of bonds go into default within 10 years. Once you start entering that junk bond category with the double B rating, then 28.4%. And once you start getting into these triple C's, double C's, it's basically a coin flip, a 50-50 chance as to whether or not the bond is going to go into default. That doesn't necessarily mean that no investors would be interested in these bonds. There are some investors that specifically focus on investing in high yield bonds, because essentially, you hear the title, high yield. Higher risk would mean higher rates of return. And so essentially these bonds would typically have very high yield due to high default probability, high risk.